Good afternoon, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys had a great day in the markets today. And in today's action, guys, well, the S&P 500 hitting a brand new all-time high. The QQQs, however, getting a little bit left behind, not hitting a new all-time high of their own. The highlight today was definitely the breadth of the market. Very good gains in financials, healthcare, even the Russell participating. The market is definitely broadening out, and that's a good thing overall. In terms of the news that we had today to make all of this possible, it was a massive deal announced this morning. Trump announcing a trade deal with Japan, setting a newly established tariff rate of 15%, which is a reduction from the 25% rate previously established. Now, we also had a bunch of earnings both this morning and after the bell. So in today's video, we're going to be doing a few things together. Number one, we will be going through the details of this trade agreement and deriving the impacts on the market. Thereafter, we'll be going through 4 different company earnings that I have prepared for you guys. Number 1 is going to be Tesla. Number 2, Google. Number 3, Fiserv. And number 4, Chipotle. So we'll take a look at those 4 different company earnings and derive whether or not some of these companies are buys or not. Thereafter, guys, we will go through our major technical analysis rundown of our major market indexes, followed by our rundown of our big tech names. How are the big tech names shaping up into their earnings, or maybe the ones that have already had earnings, such as Tesla and Google? Which ones are swing trades? Which ones are long-term portfolio buys? We will establish all of that towards the tail end of the video. And for today's video, no biggest gainers and losers section at the end. Whenever I do 4 company earnings in a single video, guys, it kind of, elongates the video duration. So I'll be doing the biggest gainers and losers section tomorrow. Whenever I either do 2 or 3 earnings, I'm fine with doing that section, but 4, it starts to make the videos a little bit long. So I'm going to try to keep them in around an hour as much as possible. So without further ado, guys, should be a very fun and action-packed video. Let's jump right into it, shall we? So the SPY up 0.85% today. The Qs up 0.46. The highlight was definitely the breadth, as I was talking about, right? So some of the big tech names, not the best day for them, despite NVIDIA having a very good day, but semiconductors were kind of mixed. They started off the morning somewhat flat because of the unfortunate decline from Texas Instruments, which dragged a lot of names down in this index. But NVIDIA, Broadcom, and AMD were definitely there to pick up the slack. They were green all throughout the day. The banks and financials had a very good day today. Healthcare having another decently green day as well. Consumer defensives, sadly, down a little bit. But the bottom half of the market, industrials and some energy companies were also there to pick up the slack on the bottom half of the market. So all in all, guys, very decent market breadth. No complaints on my part. One day relative shows that even better. Healthcare, actually the best performer of the day. Industrials, energy, financials, a lot of sectors in the green. The only one that was not was utilities, but they've been breaking out in the past couple of weeks. So just having a little bit of rotation to the downside, cooling off a bit. On the 1-week relative, you can see that all market segments are participating, which is a very good thing to see as we approach the end of the month of July. The month of July is seasonally bullish. It has so far been a very good month, but then I'll remind you, into Q3 is where the market start to get a little bit bumpy. August and September, especially the tail end of August into September and early October, traditionally not the best months for the market, so I'll be positioning accordingly, riding a lot of my longs into the end of the month and trying to wind some of those profitable positions down over the next roughly 15 to 30 days. But all things considered, guys, we had a very nice day of overall market breadth. Now, the one main thing that contributed to those gains in the early hours was, of course, the trade deal. So let's talk about this trade deal. Trump announcing a massive trade deal with Japan. Let's get into it, saying that Japan will invest $550 billion into the United States, adding that the U.S. will receive 90% of the profits. He also said that Japan will open their country to trade, including cars and trucks, rice, and certain other agricultural products. Now, this is obviously something that Japan has been somewhat reluctant to do, not just with the United States, but with a lot of other different trading partners. So this is a net benefit as well, to where the U.S. will be able to export more products into Japan. Japanese Prime Minister Shigeru Ishiba said that auto tariffs on Tokyo will be lowered to 15%. This is very good, guys. The overall effective tariff rate was 25%. That's been lowered to an overall tariff rate of 15%. The sectoral automotive tariffs used to also be 25%. They have also been lowered to 15%, which is a net positive overall for those trade negotiations. Shortly after the deal announcement, Japan's top trade negotiator, Ryosei Akazawa, said, "Mission accomplished," in a post in Twitter. Moving on further, auto exports to the U.S. are a cornerstone of Japan's economy, making up 28.3% of all shipments in 2024. So that reduction in the effective auto tariff rate is definitely going to be a net benefit. Well, obviously, 0% would be the purest net benefit, but still 15 is a nice reduction from 25. Japanese auto exports to the US fell 26.7% in June as a result of those tariffs after Liberation Day, extending May's 24.7% plunge. So this could definitely be good for certain segments of the Japanese economy. We know that automakers over there do represent a decent portion of GDP, so hopefully those sales numbers will be improving for them. Trump, in a speech that followed his Truth Social post, said that Japan and the US were also concluding an additional deal involving LNG, liquefied natural gas. Additionally, Trump said that we have Europe coming in tomorrow, and the next day we have some other ones coming in. So hopefully as well, there will be a established trade deal on the table with the European Union. We know that there's been some certain degrees of hesitancy between the US and Europe in terms of concluding a deal. There's a lot of push and pull. So hopefully this Japanese deal sets the framework that maybe European negotiators can fall back onto, or rather gain inspiration from. But overall, trade deal is better than the one that we got, of course, just a few short weeks ago when President Trump sent a letter to Japan establishing 25% across the board. So we got a few more positives: the $550 billion investment into the US, and number two, Japan opening up its economy to United States products. Trump was very positive about being able to export cars there. Now, I know what some of you are going to think. Are Japanese people even going to buy US cars? Well, maybe. Well, I guess we'll have to see, right? That's not the point. A lot of food and other agricultural products, industrial machinery, stuff like that is included as well, right? So it's a very broad topic, but that did help lift the markets in today's trade. Now that we're through that, let us dive directly into these earnings because we have a lot to cover, and we're going to start it off with some of the biggest ones. I'll start it off with Google. So there was a lot of apprehension leading into Google's earnings because of the narrative that's been placed against Google for the past 6 months. Are they losing their search dominance? Are they losing their moat to AI? Well, conclusively, I mean, there's no evidence of that just yet. Search revenue up 12% year over year, not falling back at all. That is actually an acceleration from last quarter. So if that is the argument or the narrative that Google is losing its search dominance and moat, we're not seeing it in the numbers just yet. And as a matter of fact, guys, Google absolutely crushed it. Now, the stock is only up 2% in the after hours, but that's been somewhat of a theme over the course of this quarter, guys, to where companies, even though they'll report very good numbers, such as Netflix did last week, and TSM, their stocks only slightly go up and maybe even go down the next day. We've seen it all across the board. We've been covering these earnings for the better part of the past 2-3 weeks. We covered the banks, we covered certain other companies, and although companies can have very good earnings, if they've ran a lot since the bottoms of last quarter, they're just not getting that extra lift, even if the numbers are really good. And this is as well the case for Google. Google's numbers, guys, across the board were absolutely fantastic. So let's move into some of those numbers and I'll show you, right? It's not my interpretation. The numbers are actually really good. Alphabet beats earnings expectations, raises on the spending forecast. That is the one negative element to this report overall, is a $10 billion increase in capital expenditures. But not because they necessarily want to, because they have to. They're supply constrained right now. There's just too much demand. That's a good problem to have. Let's move into it, shall we? YouTube advertising revenue, $9.8 billion versus $9.56 billion. That was a beat. Google Cloud revenue, $13.62 billion versus $13.11. That was a very strong beat as well. Cloud revenue, we'll jump into it there, but over 30%. Cloud revenue gains year over year. Fantastic. The company's overall revenue grew 14% year over year, higher than the 10.9% Wall Street had expected. That is fantastic. Tremendous beat on year over year revenue by 3%. And that's not a small number, guys. You're talking about a company that makes $96 billion in a quarter, right? So 3% definitely does add up. Moving in further, in February, the company said it expected to invest $75 billion in CapEx in 2025 as it continues to expand on its AI strategy. That has now been revised today to $85 billion, saying it was raising it due to a strong and growing demand for our cloud products and services. When asked about large spending on AI talent, referencing, I assume, Mark Zuckerberg and his attempts to poach OpenAI employees in the past few weeks, Alphabet itself says that, sure, we invest appropriately to have the best and brightest minds in the industry. Moving on further, Alphabet's search and advertising units still showed growth in the second quarter, despite AI competition heating up. Search search was doing well. Search, in terms of search, they were up 12% year over year, but even advertising was doing very strong, up about 10.4% year over year. Very strong double-digit gains across the board for Google. Cloud computing was up 31% from a year ago. That is ridiculous growth, very solid for Google. Last week, OpenAI announced that it expected to use Google's cloud infrastructure for its popular ChatGPT service. Is that not ironic, right? The same company that is supposed to be disrupting Google's moat has to resort to them to use their cloud services. So I found that ironic a little bit. That's a $5 billion deal. Alphabet CEO Sundar Pichai said that we are very excited to be partnering with them, talking about OpenAI. Net income increased to $28.2 billion. That is up 20% from the prior year. That represents net margins for Google of 29.2% net margins, extremely solid net margins, a lot of money to the bottom line. The AI Overview service, Google's AI search product that summarizes search results, now has more than 2 billion monthly users across more than 200 countries and territories. That's up from 1.5 billion users monthly last quarter. That's a lot of users in a single quarter, guys. 500 million plus people started using the service more so than last quarter. Very strong number. Shows you guys that Google can also play the AI game. The Gemini app has more than 450 million monthly active users too. Overall, guys, this was a fantastic quarter from Google. Take a look at some of their numbers across all segments. Here you'll see the legend in green right here. We have Google network revenue. That was higher. YouTube ads revenue. That was higher. You'll notice that Q4 is their best quarter, and then it goes Q1's the lowest, and then reaccelerates to Q4. So just measure the year-over-year comparables, right? From June this year to June last year, and you'll see, guys, very strong gains. YouTube ads revenue continuously expanding. Google subscriptions in purple continuously expanding. Google Cloud revenue continuously expanding. And then we have the good old Google search and other revenue, right? Which includes other forms of advertising, very strong up and to the right. All across the board, Google's lines of businesses are doing just fine. Moving into their actual earnings slides, I'll show you even more what they're doing here. Revenue 14% year-over-year gains. That's very good. The cost of revenues only up by 10%. The company once again benefiting from operating leverage as it continues to scale higher and higher. So that is very strong. In terms of the cost of goods sold, if you were to include the more R&D, the more G&A, and the more sales and marketing that they do, which are all costs that they can control, the overall expense profile was up 14%. So no operating leverage there, but just from cost of goods sold, it just goes to show you guys how effective this company is at leveraging the tools at its disposal. And there you have the beautiful net income gains of almost 20%. Now, in terms of revenue and operating income, you can see that even better, right? Very strong operating income, looking very good as well. Still maintaining 32.4% operating margins, which is very strong for this one. If we move in a little bit further, Google services revenue and operating income. Look at all this, guys, right? Google search and other, that was 12% year over year. YouTube ads, 13%, as we've already said. Google network, somewhat flat year over year, but look at subscriptions, platforms, and devices. 20% year over year. Fantastic gains from Google just on these services revenue overall, right? You're looking at 40.1% operating margins, which is fantastic. Look at the cloud. Cloud is doing amazing, guys. Really, really good in terms of cloud revenue right there. Operating margin for cloud, huge expansion as cloud scales, 11.3% to 20.7 year over year operating margin increase there. That is fantastic overall. Here we have the increase in CapEx. That's the one thing that dented the flow of the share price in the after hours. And here you can see the trailing 12 months of free cash flow. Here you can see that their free cash flow quarter was a little bit less because they are outlaying that extra $10 billion for new capital expenditures. Trailing 12 months, though, is still fairly solid, talking about a 10% increase year over year. And that is in spite of the capital expenditures that they are doing. So, guys, you know, it is what it is, right? Google had a fantastic quarter. You would be very hard pressed to pick apart this company's earnings and find anything wrong other than maybe the $10 billion in extra CapEx, but they need it. They're not overbuilding. They're literally saying they are supply constrained. They just have too much demand right now. So if we take a look, net margins are very solid. If we take a look at the EPS expansion profile for Google over the next 4 years, it's looking very solid. Take a look at the revenue profile expansion, looking very solid. Google's balance sheet is also extremely good, guys. Not much bad things to say about Google's balance sheet. A ton of free cash flow every single year. An insane amount of free cash flow, not that much debt, and decent cash still on the balance sheet. So all in all, guys, fantastic quarter for Google. There's really not much more to say than that. This chart should pretty much paint the picture that most of all their lines of businesses are performing very well. And we're not even including other bets such as Waymo. Waymo had a decent quarter. They're still expanding a little bit, but obviously the cost per mile for something like a Waymo is not going to be as effective as it is for Tesla, but the company is scaling well into many different markets. We'll do a Waymo analysis on another time, but really the focus of today should be on the lines of business that are really driving those revenues and really driving those margins. But of course, the Waymo business and the other side bets are good things to have. So they also have the 70 billion buybacks, which they're working through. Those were announced in Q1. So, right, everything under the sun for Google, not looking too bad at all. Now, this company is growing revenue by 10.1% per year for the next 4 years, and EPS gains should be about 15% per year. Is it still a buy at 195 right now in the after hours? We'll take a look at the valuation right here. Forward price to earnings at 190 is still very low, guys. Still very low at about a 19. The forward peg ratio at about a 1.25. That is very good. And trailing 12-month free cash yield of 2.8. That is slightly low, but they have been spending a lot of money on CapEx. If they weren't spending that money for CapEx, free cash yield would probably be high 3s, if not maybe close to 4. So Google, guys, is still a very decent buy right here. The company is cheap, and I will be a big fan of buying any pullbacks. I think the next 3-4 years are bright. And in terms of the narrative, is Google losing its search dominance? Well, you know, it depends on your opinion, but the numbers definitely do not show that right now. Of course, we have to acknowledge that there is competition, but Google still retains roughly 75 to 80% market share in search and browser operations. So right there is the Google earnings. Hopefully you guys enjoyed that. And congratulations if you were with me buying some of these Google dips. You guys must be very happy with this earnings report. Now we're going to dive into company number 2, and company number 2 is going to be Tesla. So Tesla coming out with earnings after the bell, and the company is currently down 4.5% in the after hours. When the earnings were released, though, the company was maintaining roughly flat. It's just been since the earnings call that we have been getting a bit of declines here. But overall, you could have expected possibly a lot worse because the numbers, objectively speaking, were not good. Let's take a look at some of the numbers right here. So they beat on, these are already sandbag numbers. So the guidance was already lowered coming into this. So EPS, tiny, marginal, fractional beat by 0.7% and a fractional beat on a lowered number by about 1%. Let's take a look at some of the overall numbers for Tesla, guys. Revenue down 12% year over year. Auto revenues and deliveries, that was up 4% year over year overall. Now, operating margin, you can see that it got absolutely destroyed in the past 2 quarters, but operating margin had a tiny uptick this quarter, but still very low in comparison to prior years. Energy storage deployed, that was one of the highlights of the business today, plus 2% year over year, but still falling from the rapid expansion that it had last year. And EPS, sadly, 23% decline year over year. Let's take a look at some of the headlines right here. Tesla reports sales miss as auto revenue drops for a second straight quarter. And we saw this coming in because we had the delivery numbers just a few short weeks ago. 16% decline in automotive revenue as sales fell for a second straight quarter and again trailed analysts' estimates. Auto revenue for Tesla came in at $16.7 billion in the quarter. That was down from $19.9 in the same quarter last year. The revenue sales of auto regulatory credits declined to $439 million from $890 million a year earlier. So their auto regulatory credits got cut in half. And I was telling everybody to pay special attention to this. This has been one of the things that's allowed Tesla to build up a tremendous cash pile over the past few years, which they still have, by the way. Companies still sitting on about $38 billion worth of cash. So cash is not their problem, but this is one very large source of incremental revenue for Tesla. And sadly now, those are being wound down as part of President Trump's new policies. In terms of early July, they reported a 14% year-over-year slide in vehicle deliveries. Tesla's slump this year is partly due to the backlash against the company in the US and Europe. Obviously, you guys know why. We're not going to do a full recap right here, but of course, you know, Tesla's early demographic were more Democratic-leaning people, and when Elon aligned himself with President Trump for the election, of course, that alienated a portion of his customer base. Then, of course, there are the events in Europe where Elon Musk was publicly promoting more conservative-oriented political parties in several different European countries, which resulted in some backlash from European customers too. And then, of course, we had the falling out between Elon and President Trump just about a month and a half ago, which alienated a portion of the right-leaning conservative customers. So on both sides of the aisle, you have some people kind of a little bit, you know, a little bit turned off by the brand right now. That's what they mean by backlash. It's just a fact, right? I'm not embellishing anything. I'm not going overboard. There's no hyperbole here. In terms of the stock, it dipped about 2% after the CFO said on the earnings call that the big beautiful bill recently passed by Congress would affect Tesla's business. The bill includes the repeal of a federal $7,500 EV tax credit by the end of the third quarter. So that will be impacting Tesla's third quarter earnings and the dwindling of the auto regulatory credits as well. Moving on further, given the abrupt change, we have limited supply of vehicles in the US this quarter because of the tariffs as well, right? So we may not be able to guarantee delivery orders placed in the later part of August and beyond. So still, the auto manufacturing business struggling a little bit. But as I've said for the past 3, 4, 5 quarters, this is not necessarily a Tesla-only problem. We have slowing sales of worldwide for all OEMs for the most part. Not only you can notice this in Ford, GM, and other auto manufacturers is because of weak consumer discretionary income and high interest rates, of course. That is nothing new. So that's what the article had to say, right? But as you know, guys, I'm always going to dive in a bit deeper, and we are going to talk about the positive narratives that Tesla does have. There were 2 of them today. So number 1 is, of course, in relation to robo-taxis. We continue to expand our vehicle offering, including first builds of the robo-taxi news. Let's get into this one first. Model Q, potentially Model Q. There's no official render for the car. There's no official car name, but they've been hinting at a more affordable vehicle. And we got a bit of an extra hint here in the earnings call. We continue to expand our vehicle offering, including first builds of a more affordable model in June, with volume production planned for the second half of 2025. Tesla also said its purpose-built robo-taxi, talking about the Cybercab, was still scheduled for volume production starting in 2026. So here it is, maybe the next big positive catalyst for Tesla to kind of spur some sales. Maybe the smaller, more economic, more affordable version, which some people codename Model Q. We'll see if that's actually going to be the name. In further news, Tesla has expanded its robotaxi testing in Austin, Texas, with a bigger operating area and likely with more vehicles coming. Musk said that the company would expand testing to the San Francisco Bay Area, but reports suggest the applications for those state permits have not been submitted, but perhaps they are in the pipeline. Separately, Bloomberg reported on Wednesday that Tesla was in talks with Nevada officials to test the company's robotaxi service as well. So expanding from Texas, maybe multiple cities in Texas soon, to Nevada, potentially Arizona sometime soon as well, and maybe Los Angeles coming in the future. So the robotaxi scale will be slow at first, but as they say, slowly and then probably all at once, right? So the news was not all bad for Tesla, but in terms of the pure hardcore numbers, well, we have to kind of say it how it is, right? Automotive revenues, guys, down 16% year over year. Energy generation and storage revenue, that was actually down 7% year over year. They had a big push on that last year. And for the past couple of quarters, it's kind of just been flat for the past 2 quarters, right? Down from the Q4 highs, that's for sure. Services and other revenue, that was a bright spot for the company, talking about, well, there's many other services and whatnot, but the supercharger network and stuff of that nature, 17% year over year. That is not too bad, but that is kind of where the bullishness starts, right? Total GAAP gross margin, that was down 71 basis points right here, year over year. It's an improvement from the past 2 quarters, which was 16.3, 17.2. So at least it's not dropping anymore, but still, right? Operating margin as well, 4.1%, which is down from the year over year comparison right there, but a bit better than Q1, which was arguably the low that the company's had in the past 4 years. If we're talking about free cash flow, this is another very tight point for Tesla, guys. Tesla used to be a company that at least they were generating $2 billion of free cash flow per quarter. No more. Sadly, in Q1, it was $664 million, and now a very tiny $146 million. Trust me, those regulatory credits and the regulatory credits, for the most part, they were heavily contributing to this free cash flow. So sadly, that is an 89% drop year over year. So the numbers, guys, let's be honest, right? They're really not fantastic. Now, in terms of deliveries here for Q2 were better than Q1. Everybody knows that Q1 is Tesla's softest quarter, but that is somewhat a flat deliveries, right? In terms of overall production, from quarter over quarter, year over year, Q2 to Q2 is what I'm talking about there. So sadly, that's the case. So production is the same, but deliveries, guys, deliveries is down 13%. But we'll see. Maybe if they release the new model coming out later this year, maybe that will spur some sales. Storage deployed in terms of gigawatt hours, in terms of the energy division, well, that was also, it was up 2% year over year, but down from Q4 and Q1 just prior, right? So the supercharger stations and connectors, those are increasing. They still have the best supercharger network on the entire planet. You got to say it how it is, right? But look at the market share. Look at the market share of Tesla, right? US and Canada, it's actually falling. Europe is actually falling. And it's not been since now, guys. It's been for the past 2 years. It's either topped out or stalling. You can say that other car manufacturers have caught up, both in terms of technology, but also in terms of affordability. So that's why Tesla is kind of slowly losing a little bit of market share. Now, we do have a lot of work being put on FSD miles from V12 and beyond. Here you can see that the company's been driving a lot of miles for full self-driving, so that's going to be improving the robotaxi services. Energy and other, we can see it's kind of tapering off, right? Kind of tapering off in terms of gross profit right there. And in terms of energy deployment, we also have a slight taper off. Now, maybe it's just 1 or 2 quarters. Maybe we resume growth later on in the year, but for now, tapering off a little bit. And I'll show you some of the problems, right? The problems we already know, right? It's the flatlining of most things. Vehicle deliveries. They've been flat, guys, for the past 2 years. No quarterly expansion. Free cash flow, the red line right there, has been coming down for every single quarter of the last 4 quarters. And here you can see net income as well. Net income, sadly, is dwindling, right? Used to be very high 2-3 years ago and now dwindling. Now, a good part of that, I do agree, is because the consumer has been weak. Overall, car sales for all manufacturers have been weak, but these are just the numbers for Tesla, right? They're not doing well in this current environment for a number of different reasons, which we've already stated previously before. We can go into more charts, but I think you guys get the idea, right? So Tesla. What is the analysis on Tesla overall, yeah? The analysis on Tesla, guys, has always been the same, right? Certain people like to focus on the short term, and they will say, well, the company is not doing very well in the short term. They have a very high price to earnings ratio of 174, a very high PEG ratio of 4.46. How can Tesla possibly justify a $320 share price? And I get it. The numbers are not good. We have slowing sales growth worldwide. We have price cuts and incentives, which are leading to trying to increase more demand, but are indeed leading to lower margins and lower free cash flows. We have the loss of the regulatory credits, $7,500 tax credit for new buyers. We have the China price wars. We know that China's been putting out some pretty good EVs, objectively speaking, in terms of the tech and the pricing. And brand perception has also been a short-term negative for the company. These are all the things that we know. Everybody knows this. What are the long-term positives for Tesla? And Elon says this all the time. If you do not believe in this long-term thesis for Tesla, you should not be investing in the company. And this is what a lot of long-term investors in Tesla look past. They look past the short-term negatives, which is normal, and they focus on the long-term positives. Solving full self-driving for the robotaxi purposes is a multi-trillion-dollar robotaxi business. I'll just say it as it is, guys. Sure, there are other robotaxi services, but Tesla has the de facto lowest cost per mile. Google's Waymo will never be able to achieve the cost that Tesla can do for running its robotaxis. Never. The cost of goods sold on Tesla vehicles is just too low. It is lower by a factor of almost 4 to 5 every time Waymo spends money on a Jaguar and equips it with its LiDAR systems. It's about $150,000 to $200,000. Cost of goods sold for Tesla right now per vehicle sold is roughly around 30 grand. So as a result, Tesla will always be able to utilize its vehicles with more leverage. They will have the de facto best cost per mile, right? So solving FSD and ramping up the scale and production, if people still choose to get into the robo-taxis, if the brand perception is not too bad, if people still choose to use them, right? Well, then FSD will indeed be probably a multi-trillion-dollar opportunity. As we've seen numbers from Waymo, numbers from other robotaxi services, people are indeed using them. But will they use Teslas? The question obviously is up to interpretation. They have the most extensive charging network worldwide. They have one of the most advanced robotics divisions worldwide, with their plays on Optimus robots coming in the medium-term future. Not this year, not next year, maybe not in 2 years, but 5-10 years out. They'll have a good chance of having a good market share there. Solar and energy and storage expansion. This is true, although the business has been somewhat flat the past 2 quarters. Probably not going to last forever. They are one of the market leaders in terms of energy deployment and one of 3 worldwide positive free cash flow EV manufacturers. This is true. Not many other companies can manufacture electric vehicles, guys, at positive free cash flow and positive margins. Only BYD, Li Auto, and Tesla are able to do it for now. And the cost of goods sold efficiency in offsetting the price cuts somewhat. They are very good at reducing their cost of goods sold, which also leads them to have possibly one of the best cost per mile, right, in terms of robo-taxis overall. So that being said, guys, the numbers, the valuation here at 320 is expensive if you only look at the short-term car business, right? Personal car business. Now, that being said, it is extremely expensive. However, if you look at the long-term positives and just focus possibly on the market cap, you know, Tesla can expand 2-3x from here. I know it sounds crazy, but it's really on the robo-taxis, guys. If they can scale this network properly, it's a ton of cash into the next 5, 6, 7, 8 years. Then Optimus comes on. We'll see if they can actually regain a bit of market share if they start expanding with their lower cost vehicle, and the brand damage and brand perception are not too negative. So Tesla is a tale of two stories. You either hate it because you feel that their short-term car business is not doing too well, or you absolutely love it because you have a 5+ year time horizon for your investments. The decision is up to you, but any investor in Tesla right now probably should not be investing in it for the short-term car business. You should be investing into it for the long-term thesis, because only then do these current numbers and current valuations make sense if you project into 2028 to 2030 and beyond. So hopefully that was a fair and objective analysis from Tesla. I still have some shares, I will admit, not close as much as I had back in 2021. And early 2022, when I sold a decent portion of my Tesla holdings, but I still do have some because I still do believe in the long-term thesis. So that being said, that's everything I had for you guys for Tesla. Spend a bit more time on it because I know Tesla is a very polarizing stock. Now, stock number 3 we're going to be covering, guys, is going to be one that at earnings this morning. This stock was down 22%, guys. This was 4 times the expected move. The expected move for earnings was 6%. It went down almost 22% early this morning, almost a 4 standard deviation move. Why? Well, they got an ASML pulled on them, essentially. They revised their guidance for revenues down to what they had previously said. Their previous revenue target was 10 to 12% expansion for the year. That was the target range. And now they said, well, it's going to be closer to 10% instead. Still above 10%, but closer to 10 than closer to 12. And as a result, the stock dropped 22% before rallying about 10% and ending about 13-14% down. This has been the case, guys. I mean, we've seen this time and time again during this earnings season, right? As a matter of fact, the only companies that have performed really well after earnings, I mean, we can look at a few. Interactive Brokers, very good, but what did they do after earnings? They did very good, gave it all back in the next 2 days. GE Vernova, because they're on topic and they have a very strong niche right now, they performed very well, but the valuation is quite excessive. They were up really well because of the nuclear and energy deployment services that they offer too. Other than that, guys, the only ones that have performed well were Pepsi, and you'll notice a common theme. Pepsi performed well, but why? Because the numbers were so bad. They were expected to be so bad that they're showing, no, actually, they've stopped being really bad. They're still bad, but they're getting less bad. Another example of that was Nike. The numbers were still objectively bad, but they're getting less bad, so the stock rallied higher. United Airlines, they rallied 14% after their earnings. Why? Well, because they were expecting the numbers to be really bad, and they were just less bad. But companies that have been reporting really solid numbers, such as Equifax, such as you can make an argument for MSCI, such as Micron, just a few weeks back, right? Micron earlier, back in June, they reported great earnings. They were down. TSM reported fantastic earnings. They went up, but then came down thereafter. You're not getting the pops, right? Netflix reported very good earnings. They've been down ever since. We've been seeing a common theme. Even Texas Instruments reported earnings yesterday, and we covered them on the channel. I didn't think they were that bad at all. They were down. So once again, another example of this. This time, Fiserv, 14% to the downside. Let's take a look at the numbers, and you guys tell me what you think. So Fiserv coming out with earnings, 1.44% beat on EPS, and a fractional beat on revenues. Now, if you guys don't know what Fiserv does, let me introduce you to the company. Some of you guys already know, but they have a very large ecosystem of between merchant solutions and financial solutions. I'll explain what the two are. So merchant solutions, you might have seen these little terminals right here, the Clover terminals. Whenever you tap your cards, those are merchant point of sales solutions, right? Very popular service for the company and is one of the fastest growing demographics of it. But you might use Fiserv and you don't even know it. They almost have 100% of all US households reached. Why? Because of their financial services segment right there. The bill payments. Whenever you guys do bill payments, either on your phone or through a bank, they handle a lot of bill payments overall. 20 million users using those. In terms of gift cards being activated, they do gift cards. In terms of when you withdraw money from an ATM, they provide a lot of back-end banking services. Either when you tap your debit card, even when it's not a Clover terminal, they do a lot of bank-to-bank transactions, bank-to-merchant transactions, a lot of the back-end back-end stuff, right? In terms of digital banking, a lot of functions on banks' mobile apps, such as bill payments or loan applications, are also ran through Fiserv's network too. They're a very, very large network in terms of the number of things that they do, but as a result, they're not front and center, right? You don't even know that you're using them sometime. However, very, very, very strong, guys. 325 million deposits and loan accounts, 10,000 overall Fiserv clients, talking about banks and different financial entities that use these services, right? So a very wide company in terms of the different things that they do. Now, let's take a look right here at some of their numbers, shall we? So revenue year over year was a 8% beat. Very good. EPS, 16% gain year over year. Net income, 13% year over year gain as well. Every single metric on the books was a beat, but just because they said that the revenue, here was the guidance, guys. Here's the one thing that dropped the stock by 22%. Massive overreaction, in my humble opinion, and everybody today was saying it was a massive overreaction on different networks. The only reason, guys, if I can find you their guidance, give me a very quick second. Sorry, I don't want to spend too much time on this. It's right here. Previous 10 to 12% organic revenue growth metric, now around 10%. Wow. Okay. All right. I guess that's enough, right? Adjusted EPS, though, they upticked the bottom end of the range, still 15 to 17% growth. All in all, guys, Fiserv's numbers were very good, and I'll show you, right? There was nothing bad about this. Adjusted revenue was up 8%. Operating margins, they also improved on a year-over-year comparison to 39.6. Very strong. This is a company, guys, that makes very solid net margins for a payment network. I mean, they've been upticking their margins right now to the teens, mid-teens, 15, 16, 17%. Nothing wrong with the company whatsoever. Right? So let's move further into a bit of their earnings slides right here, and I'll show you. So here we go. Merchant Solutions, right? Very strong. Operating margins, that was down slightly. Ever so slightly. So Merchant Solutions includes a lot of their Clover numbers, right? In terms of this was the aggregated numbers. In terms of Merchant Solutions only, you can see here that small business, 9%, enterprise, 8%, processing down 1%, but that is the smallest. Those are the processing fees, right? Whenever you swipe your card or whatnot, they were down 1% year over year. But still, guys, right? In terms of year-to-date growth, yeah? So overall, guys, not too bad. Not too bad. That's the smallest segment right there. Their biggest segments were actually growing very well. Now, in terms of the Clover volume here, Clover reported volume here of 8%, 8% volume growth, which is pretty good. Gateway conversions, 11%. Very nice. Financial Solutions. Now, this is arguably one of the bigger segments. You can see here that, Merchant Solutions brings over 2.6, but the financial services is very heavy for these guys as well, right? Look at these operating margins for this segment. 48.7%. That is an increase of almost 3% year over year. So some people were a bit disappointed with operating margins on Merchant Solutions and somewhat slower revenue growth than anticipated, which was the reason why they reduced their guidance in terms of the revenue to the bottom end of the range. But it definitely was not the financial solutions aspect of it, where, let's be honest, most of their clients were. Very, very strong, guys, overall. Digital payments in terms of year-to-date growth, 7%, issuing 11%. Banking has been flat, though, at around 625. But once again, their lowest segment of all three segments right here that comprise financial solutions, that was the only, I guess, it's not even a red flag, right? But the only thing that was less than stellar for the company. In terms of other things that they did, well, they announced an agreement to become the merchant processing provider for TD Bank in Canada and acquire a portion of their existing merchant processing portfolio. That's a big deal for Fiserv, guys. That's 3,400 merchant relationships and 30,000 locations to the portfolio. That is very, very, very strong, a very strong agreement that they got into today. And also, they launched the Fiserv USD stablecoin for financial institutions and merchants with partners, MasterCard, PayPal, Circle, and Paxo. So being part of the stablecoin network and also now having a more robust network as they continue their expansion into Canada and continue their expansion into the rest of the United States. All in all, though, guys, do we see anything bad in this report so far that could merit a 22% decline? No. Look at this free cash flow improvement, guys. This is nuts, right? Improving free cash flow by $1.3 billion. Very strong, maintaining an end-of-year free cash flow guideline of $5.5 billion. That would be, tentatively, at the current price, a free cash flow yield for the end of the year of 6.96%. That is extremely, extremely strong. We're going to get into the valuation in a little bit, but I just want to continue showing you guys these numbers, and they continue to return value to the shareholders, buying back a whopping $6.9 billion in shares for their shareholders, which was about 6-7% of the entire stock's float. So all things considered, guys, a very solid earnings. There's really nothing here to warrant a 22% decline, but we've said it once, I'll say it again this quarter. Earnings, guys, this quarter are very solid, and I would rather have solid numbers but awkward price action reactions, because if I can look through the short-term negativity in terms of price actions and find companies that have reported good numbers with solid fundamentals with expansion into the future, this is when you possibly find some mispriced assets, right? When companies are reporting good numbers, but for some reason the algorithms just sell them down, they are buying opportunities, as opposed to companies who report bad numbers and get possibly bid up. Those might just be traps, right? So keep that in mind. So I'm a big fan of finding some of these companies that drop a lot after earnings for arguably no good reason. I mean, I would understand like a 4, 5, 6% drop, but 22% at the bottom, that's a little bit excessive, right? So take a look at Fiserv in terms of valuation at around 140 bucks right now. They're trading at a 13.65 forward price to earnings. That's a very cheap multiple, guys. You're talking about a company growing EPS by 15% per year, and they're trading at a very cheap multiple right now. The PEG ratio under 1, 0.85. That is very, very, very good. One of the most attractive deals in the market right now. Even better than PayPal, guys. PayPal's PEG ratio right now in around the 70. Well, it's actually higher now. It'd be about 1.2. Fiserv actually a better deal, and they are actually growing revenue and EPS faster than PayPal. They don't do the exact same things, but we're comparing against the fintech landscape right now. Price to sales of 4.41 is very fair, and the free cash yield is absolutely insane. This, for me, is a buy for Fiserv, and as a matter of fact, I'm not the only one saying that. The company is down 31% year to date. I think it got hit unfairly after earnings. And as a matter of fact, the price targets from most analysts and most banks are, for the most part, largely above the expectations right now. 206 is the midpoint, 266 is the high point. So there's a very decent risk to reward profile on this stock right now. EPS crushing it into the future, and revenues going to be crushing it into the future as well. I like this company. This one for me is indeed a swing trade, but also possibly not a bad idea for expansion of the landscape. You know, not just a short-term swing trade for price action recovery, but maybe also like a longer dated position for the next 1 to 3 years type of thing. I like this company. I like their direction. In my opinion, bit of an unfair reaction there. And lastly, we're going to talk about Chipotle. So Chipotle, sadly, guys, going down right now in the after hours, 10%. And no, this was not a case of the company reporting good numbers. This company actually reported bad numbers. So they were down 9.72, but we know the consumer discretionary landscape, especially fast food and other offerings, has been a bit challenging. Let's take a look at some of the numbers, shall we? So beat on EPS by 1.24%, but a miss on revenue by 1.56. But that wasn't the worst part. The worst part came through their same store sales. Let's jump into the article, shall we? So here we go. Chipotle stock tumbling 9% after the chain cuts its same store sales forecast. Let's go into the article, shall we? So here we go. They cut the forecast for the same store sales growth this year after traffic declined for a second straight quarter. The burrito chain now anticipates flat to the same store sales growth for 2025, down from its prior projection of a low single-digit percentage increase. So sadly, Chipotle will not be increasing same-store sales at all. Bring you guys some of these statistics here. You can see that revenue was up 3% year over year, average store sales flat year over year, and pretty much going to be the same for the end of the year. Operating income taking a hit of 5% down year over year, and EPS negative 3% year over year. So a tough landscape right now. Operating margins have been maintained overall. Restaurant level margins is the top line, and total operating margins also continuing to be okay, but a far cry from the Q2 that we had in 2024. So some difficult year-over-year comparisons, but we have seen an uptick here in the past 2 quarters as the company tries its best for some cost savings in a very difficult environment. We've heard the same thing from Pepsi, Coca-Cola, McDonald's, and other, either food and drink distributors and or quick service restaurants. Moving forward, take a look here. Chipotle trimmed its same-store sales outlook for the second consecutive quarter. But the company says sales trends are turning around. Starting in June, customers have been returning to Chipotle restaurants thanks to its summer promotions and the launch of its adobo ranch dip. Now, I highly doubt that people are just going to Chipotle for the ranch dip, but probably more so because of these summer promotions. A lot of other businesses have also been resorting to promotions such as Chili's and such as the one that we looked at just a few days ago. We looked at Coca-Cola, we looked at Pepsi. It's a common theme. We looked at McDonald's last quarter. Promotions in order to get the customers in the door. Moving on further, Chipotle's net sales rose 3% thanks to its new restaurants. Only thanks to its new restaurants, so more locations, more sales, but same-store sales have been flat. The company's same-store sales actually shrank 4%, right? So the end of the year guidance is flat. quarter over quarter, 4%. Tough comps from last year, or rather, year over year, but, Q2 to Q2 comps when I say that. Steeper than last quarter's decline of 0.4 and sadly falling short of the estimates of 2.9. So coming in worse than the estimates. Average check increased roughly 1%, which partially offset the traffic declines of 4.9%. So less foot traffic. Very unfortunate for Chipotle. Last year, Chipotle outpaced the rest of the restaurant industry, bucking a trend of sluggish sales and traffic declines. No longer, though. But by the end of December, the company started seeing softer sales of its own. Diners' concerns about the economy led them to skip restaurant visits and save their money instead. May was another tough month for Chipotle. However, by June, same-store sales began increasing again. Exiting the quarter, here's what the CEO had to say. Exiting the quarter, we returned to positive comp and transaction trends, which have continued into July. Not enough to lift up the stock share price, though. He later reiterated that the company's belief that it can return to same-store sales growth in the mid-single digits in the long term, but short and medium term might be a little bit tricky for them, yeah? There's no smoking gun here that says we've had a misstep. Talking about, well, it's maybe not their execution. It's maybe just the overall market. And that gives us confidence to stay on strategy, innovate where we can try to meet the consumer where they are in our own unique Chipotle way. But more importantly, to really continue execution in the restaurant, delivering great team member experiences and great guest experiences. So kind of reiterating what Domino's said the other day, to where, they notice the economic trends happening right now. They're trying the best to resort to sales and promotion incentives, but maybe true growth, possibly not much before the back end of this year, or maybe even in 2026. Now, Chipotle reiterated the forecast that it would open between 315 and 345 new restaurants over the course of this year. One more highlight, of course, you have to counterbalance some of the negative news with one piece of positive news, and that was the fact that they were doing an additional $400 million in buybacks, which were approved by the board of directors, approved back on June the 10th. So that can possibly help the stock a little bit, but $400 million, guys, I mean, Chipotle is a $71 billion company. An extra $400 million definitely is going to contribute something, right? But maybe not an astronomical amount. It is still, though, a very nice 5%, increase in, or rather 5% of the total float that can possibly be bought back again. So everything like that, guys, not too bad, or rather, 71 billion. Give me a quick second. And we're going to take a look at the numbers for Chipotle overall in terms of where do they stand, guys? At $47, where we currently roughly stand in the after hours. Is it a good deal? Well, unfortunately not. They're still having very decent net operating margins. As I said, they're controlling costs where they can and trying to incentivize customers to return with promotions, of course. Now, that being said, guys, at $47, still trading at a very high multiple, 38 forward price to earnings. They have a very nice EPS growth rate for the next few years, but still, that gives them a PEG ratio above 2. Above 2 for a PEG ratio in a tough landscape right now, in a tough segment of the market, is just a little bit too high for me, guys. The risk premium here is a little bit too high for me to afford. Free cash yield at 2.1% is still a little bit low. The price to sales is not that bad at 5.8. McDonald's is an 8, but then again, McDonald's generates roughly twice the net margins that this company generates. So you can argue that maybe McDonald's is a little bit more deserving of those heightened valuations. But sadly, Chipotle, for me, guys, is not a buy up here. I mean, if you're buying it, you really have to have a longer duration time horizon. I don't believe the company is going to struggle to expand the business. They're still opening new stores. EPS will be coming higher over the next 4 years, and revenue will be coming higher over the next 4 years as well. But you are factually paying a lot for that growth. They have very nice revenue and EPS run rates right now. And even in spite of that, guys, well, the valuation is still expensive. So perhaps Chipotle's explosive growth is now behind us. Perhaps now we embarked on a more normalized period of growth for the company overall. If you ask me where I would truly be interested, you would really have to give me low 40s. I'm not saying it's going down there. I'm just saying if you want to get me interested, that's where I would be interested and feel like I'm getting a bit better of a deal. So still remains a very tough landscape, guys. Quick service restaurants, we heard from Domino's. Now we hear from Chipotle. We're going to get to hear from a few more over the course of this earnings season. And with that wraps up everything for our earnings today. I know. There was a lot, but hopefully I was able to, provide some insights into those 4 different companies. And now let's move into our indexes. So I'll try to go through these as rapidly as possible, try to wrap up the indexes and our big tech names in the next 20 minutes. Try to keep the video under an hour and 10 minutes long. So this SPY, there's really nothing to see here, guys. Rotation still is in a healthy momentum to the upside here. We're looking for a new daily higher low on any pullbacks. The bulls are in control. Anything above 618, looking for a higher low. For possible further trend continuation, things to look out for in terms of the near-term future. Tomorrow, you have manufacturing and services PMI. Those should be interesting releases. But what might come over and above that is in the event that we get a trade deal with Europe, that will probably be beneficial for the markets too. In terms of earnings, we don't have any more big tech names tomorrow. Couple key players, though, tomorrow, Union Pacific, you got Keurig, oh, sorry, I'm in the way again. Keurig, Dr. Pepper, Honeywell, stuff like that, Decker's Outdoor Brands, Intel, of course, right? One of the airline companies, American Airlines. But overall, no crazy large earnings releases for the rest of the week. So keep all of that in mind. It should be more muted moving forward, maybe more focus on some of the trade deals if more come through the pipelines, but the SPY is looking very good. And even if we unwind here, guys, into a daily downtrend for XYZ reason, right? You're just going to be looking for a higher low on the indexes, anything above 592 on the weekly, looking for a higher low for a continuation of the weekly uptrend, and beautiful support down there, 610 to 590. QQQs are looking largely the same. You can see here they are up in the after hours by about 0.32%. because of those positive results from Google. Keeping an eye on the trend right now. We know the bulls are in full control of this daily uptrend. The higher lows are this yellow line right there. At any point, we get a pullback looking for a higher low for possible further trend continuation, and the higher lows are 551. They've been riding the heck out of this 12 EMA. So if you want to see the markets go into true weekly consolidation, well, two things need to happen. One, you need to get a daily downtrend, but you also, at that same time, need to flush this 12 EMA, which is your short-term momentum moving average. And only then you will understand you're maybe going into a bit of weekly consolidation. The target for that could possibly be a backtest of prior resistance, newfound support, which would be 537 down to roughly 523. On to financials right now, having a very good day. The bulls kind of getting back in control of this one. Daily downtrend, beautiful engulfing move. And now it's up to them to reset the daily uptrend on any declines. They got a lot of space to do that. Anything above 51.36, looking for a new higher low for possible a reset of the daily uptrend. The cleanest time frame of them all was always the weekly time frame, guys. Beautiful, beautiful, beautiful weekly uptrend right now. Higher lows are set at the lows of last week. 51.22, looking for further progression of the trend expansion, reacting beautifully from our support range 52.21 to 50.28. No red flags in my humble opinion here. On to healthcare right now. Healthcare finally starting to come alive in the last 2 days. So pay attention, guys. Some pretty big healthcare players on the Friday session for some of your earnings. Number one is going to be HCA Healthcare, right? They do all the hospitals. And number two is going to be Centene Corporation, CNC. Can they provide some positive outlook for the health insurance sector that has been absolutely decimated over the course of the past 2 quarters? That might prove to be if that does happen, if they do provide some positive insight and rally, maybe we get a further bump from healthcare, guys. I know a lot of you guys thought that healthcare was down and out, but I've been very clear on this, right? Underperformance by an entire sector does not last forever. And this has been one of the most pronounced divergences away from the S&P's performance in a very long time. That does not last forever. Eventually, it will come back. The cleanest time frame right here is the weekly. If we can get a weekly expansion candle and crack above 137, that is a new weekly uptrend for healthcare. And then, my friends, we will be progressing to a very nice monthly bounce and look to reset the monthly uptrend sometime maybe into the end of the year, but reacting very nicely from our support range. I am still a fan of accumulating healthcare positions. I think it's one of the most undervalued sectors in the entire market, and you could be surprised by the gains that you might have end of the year and especially into 2026. Moving on to SMH right now. So SMH up about 0.43%. We know that yesterday was a bit of a challenging day for SMH, and today as well a little bit. Daily higher lows have been cracked at 284. So you're kind of looking at now a slight daily downtrend. If that does continue, guys, because we lost the 12 EMA, and we are slightly losing the daily uptrend as well. Now, we didn't get the follow through today, but if it does follow through, what are you looking for? Very simple here, guys. You are looking for a weekly higher low. The likely area of retest would be 275. The lower area of retest would be 260 to 250. Who knows if we actually get it? Maybe we only get a shallow retest, or maybe we get the absolute full retest. Both of them are very healthy retracements, though. Sector is slightly overbought, and I would be a big fan of buying the dips on my favorite individual companies. Maybe not the whole sector. SOXX paints a better picture right here. The support range is a lot closer, right? It just depends on the weighting of these ETFs, How much weighting do they have in the top performers, AMD, TSM, Broadcom, and NVIDIA? The SOXX has not performed as good as SMH. So the backtest location here looks a lot more clean, in my humble opinion. Moving on to IWM Russell right now. The Russell starting to get some legs right now. New daily uptrend and trying to attack resistance for a second time. 231 down to 225. We've been noticing the cleanest time frame was the weekly. It was trapped, right? Sideways accumulation. You could argue that this was some form of a bull flag here, trying to hog the 12 EMA as best as they can, and now looking for a bit of expansion. Weekly bulls never lost this time frame. They were always in control. Bit of hesitation right here, but now just continuing higher. We will see if they can crack the resistance range. 231. If they can't do it and we pull back in the markets, you're looking for a higher low. At that point, I'd be looking to support 216 down to 207 to reposition. That's everything for your index analysis. We will jump over VIX, dollar, and the yields today because for the most part, they just have not moved, guys, right? I mean, yields have been oscillating, but we'll do them tomorrow when we have less earnings on our plate. Moving into gold right now. Well, gold actually had a red day over the course of the Wednesday session, down 1.29%. Daily uptrend is nicely underway. You're looking for a backtest of where you might ask, well, these guys right there, you can clearly see, right? Resistance, 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 resistance. Now maybe support, and the short-term EMAs are cooperating too. So daily uptrend is still in the bulls' favor right now, possibly looking for a furtherance of that expansion. Why do we have a bullish leaning bias? Because the weekly is not looking too bad, right? Looking for a weekly trend expansion. Next target into 35. If you guys want to see the absolute short, well, first things first, you need to reverse the daily uptrend into a downtrend, and then we can talk. But as of right now, the bulls in short-term control. And crypto pulling down a little bit. The altcoins, as you can see, a lot more than Bitcoin, but Bitcoin kind of holding its own, right? The altcoins had a phenomenal rally over the past 2 weeks. Healthy price action pullbacks, in my humble opinion, right here. This, you can make an argument, is a bull flag. Why? We are holding the 12 EMA, have not cut the lows, 115,800. If you drop those lows, that's the daily downtrend, and that is further weekly consolidation. But right now, the bulls keeping very tight. Would not be surprised, as we do have a bullish weekly leaning bias, right? It's a beautiful weekly uptrend right now by the bulls, looking for a nice push. Hesitation up here, no cracks. The bias is still for long continuation into the next target of 125K. And if we don't get it and get the slide, you guys know the drill. You're looking for a weekly higher low, anything above 99, looking for a weekly higher low for then possible further attack of the 125 psychological target, and the pullback zone would be 111 to 109, the previous area with which the bulls were struggling before. That's everything for your overall market rundown. Now let's jump into our big tech list, shall we? All right, so taking a look at first Apple down 0.12%, very small, but we know what's been happening with Apple here. They're struggling with the resistance range. 221 down to 213 is that resistance range. Also trying to keep closing above this 200-day EMA, which is proving a challenging endeavor for the bulls. However, the bulls not looking too bad, guys, right? Bit of consolidation, bull flag right in the 12 EMA, now above most of your daily EMAs. Been a long time, right? Since we have a period of time for Apple being above the daily EMAs for roughly 3 weeks in a row right now. Looking not too bad. And if we pull back from here, you're looking for a higher low. Anything above 207, looking for a higher low for possible further trend continuation. I'm looking forward to Apple's earnings next Thursday to see if they can complete the prophecy. Can we get a beautiful weekly uptrend continuation, break through this infamous resistance range, which is proving to be a bit challenging for the bulls? In my opinion, it's going to be tough for them to do it prior to earnings. One thing's for sure, though, if for ever which reason after earnings, because we only have about 4 days, 4 or 5 days of price action before them, and then earnings is going to move the stock probably 4 or 5%. So if you make it all the way up here for earnings, get rejected, or just move down into here before earnings, I might be looking to position on Apple once again in the lower 200s, but the stock is looking good. You guys know that I bought a leap call contract just a few short days ago at the bottom end of this range, looking for follow through. The time on that is all the way through 2026. I'm looking for a recovery story in Apple. I know. They have their AI problems. They have the tariff issues and whatnot. I know, but they're down 15%. It's a major component in the S&P, and I would not be surprised if the market continues being bullish if Apple can get a very decent leg of catch-up. I'm not looking for crazy all-time highs and crazy expansion. They don't have the revenues for that, but just a little bit of a catch-up leg back to like 230, 240 over the course of the next 3-4 months. I think that's possible for the company, right? Not asking for too much. On to AMD right now. AMD up 2.54% in the normal hours at 1.45 in the afters. Why? Well, because of the renewed CapEx commitments by Google. A lot of the semiconductor names performing well in the after hours today. So AMD looking very solid, guys. Not too bad at all. Backtesting the support range. 154 down to about 145. Keep an eye on the 12 EMA. As long as the bulls are riding this, guys, they are still going to be in full control. If you want to see a bit of a weekly correction, you're going to have to establish a daily downtrend, a loss of the 12 EMA, and then we can talk about a weekly pullback. If you do get that weekly pullback, anything above 133, looking for a higher low. However, short-term pullbacks, in my opinion, are still buying opportunities for this company for the very clear reason, guys, that the company still remains undervalued, even around 155, 160. I know you think you're late because you have anchoring bias, meaning that you think you could have got it back there or here. So as a result, now it's not a buy. Don't think like that. Look at the numbers objectively. In absolute terms, is it a decent proposition? Is the company undervalued? The answer is still yes, as they are looking to expand rapidly margins, revenue, and EPS over the next 4 years. Here's EPS, crazy ramp there. And look at this revenue ramp as well. AMD probably has a lot of upside left into it, guys. So keep that in mind when you're thinking about positioning. Moving on to Amazon right now. Amazon up 0.36, up another 0.71 in the after hours. Probably because Google's advertising division did very good, and Amazon also does a decent amount of advertising on their own, and cloud, of course, right? AWS for Google Cloud, and then AWS for Amazon. So Amazon's still struggling with its resistance range, 228 down to 218. Not quite free and clear of the resistance range just yet, but very close. The bulls are in control. You can see clear control of this 12 EMA and clear control of the actual trend. Any move lower looking for a higher low. Anything above 222.60, higher low for possible further trend continuation. Amazon has earnings next Thursday. So you probably won't see crazy expansions to the all-time highs before then. You probably also won't see crazy breakdowns below 217. Maybe we just kind of hover in this resistance range. In the event into earnings or after earnings, we drop, because everybody wants to know what happens if it drops, yeah? Well, the weekly bulls will still be in control, guys, right? They have a lot of space right now. Anything above 207, looking for a higher low. And I will be a fan of buying a lot of those declines. Amazon's still one of my favorite companies over the next few years. And in here at the 220 region, is it expensive? Objectively speaking, no, not quite. Moving on to Google right now. Google down about 0.31 in the normal hours, but 1.85 boost in the afters. We will see if they can maintain this gain into the session tomorrow and close a weekly candle above our resistance zone so I can actually close this box green. Moving on to the analysis here, daily uptrend is very nice. And even if we pull back into it, guys, you're probably looking for the good old breakout at this point, retest, right? This whole region can be now used as support. That being said, anything above 181.50 would just be looking for a casual higher low for possible further continuation. And on the weekly timeframes, we have very clear price action control for the bulls too. Looking very, very solid right now. The most recent higher lows are set down here at 165. Beautiful leg of expansion. In the event we have to consolidate, Google has tons of space, and I will be a buyer. We just covered their earnings. They were fantastic, and the stock is still fairly priced in my opinion. Moving on to Meta right now. Meta up about 1.24% today. Very strong day for Meta as well. Still bouncing out of resistance. 702 down to about 680 is the resistance range. Daily downtrend, the bulls are trying to get this one back. We will see if they can do it. They have earnings next Wednesday. Not too many sessions. I'd be highly surprised if Meta can crack all-time highs before earnings or crack these lows before earnings. Maybe we just stay a little bit muted on Meta prior to that time. That being said, the bulls are still looking good on the weeklies, right? Beautiful weekly uptrend. The higher lows being set right now at 680. Looking for possible further trend continuation. I think Meta's going to have pretty good numbers in around the 720 range. They're still trading fair. I would say Meta's fair. It is a little bit on the rich side, I will agree, but still fair in light of their margin expansion and their free cash flow expansion and revenue and EPS expansion in the next few years. I won't necessarily be positioning into Meta for their earnings. I'm still holding all of my shares, but if we do pull back after earnings under 700, I will be a fan of adding to that position as well. Moving into Microsoft right now. Microsoft up about 0.12%. Microsoft, first time, or rather second time, I mean, they came below it. They did not close below the 12 EMA, but you can see, right, it's getting a little bit bumpy for Microsoft in around the all-time high area, which is just above $500. If you flush these lows, 496, you have lost the daily uptrend. You open up the door for the daily downtrend, but we won't have time for that because they have earnings on Wednesday, right? So maybe Microsoft is unable to push much new all-time highs here, but probably they also don't drop off a cliff. Microsoft expected move for earnings is about 5%. And if Netflix is anything to go off of, right? And all the other companies that have had great numbers, but either gone up a little bit or have gone down, if Microsoft's rally from earnings, right? If we just take what's happened with a lot of companies, If Microsoft reports numbers that are in line or even a little bit better than expected, but are not crazy fantastic, maybe it results in a drop, just like Netflix. If that does happen, I'll remind you where we're looking for. 470 for a pullback zone would be a decent area to position for some further trades. No further trades from me. I'm not selling any shares up here. I'm holding all my Microsoft shares because I'm a long-term investor, but I will possibly be looking to play any and all pullbacks. Speaking about pullbacks, we'll take a look at Netflix. Netflix actually closing below the support range for the first time, currently trading at about 1176. They were down 1.12% today. Daily downtrend, right? We were commenting on this ever since earnings, that a fantastic quarter, and now we're unwinding, but it's a very natural unwind. It is a loss of a weekly uptrend because we've now cut the lows on the weekly time frame. It doesn't mean we're going to go into some log form extended downtrend like this. No, but this might just take a little bit of time to recapture, right? So that being said, Netflix, the cleanest chart for me is the monthly. This is just very clean and healthy monthly consolidation after a gorgeous rally, maybe looking to normalize a little bit. Where I would get more interested for this one, probably around 1100 or 1050. If we can come closer to this 12 EMA, you can see Netflix over the course of the past few years, it loves to do this. Strong rallies, pull back close to the 12 EMA. Strong rallies, pull back close to the 12 EMA. Strong rallies, sideways action, and eventual pullback to the 12 EMA. Maybe we can get close. I will be a fan of participating if we can make our way into the $1,100, $1,000 range. Moving on to NVIDIA right now, 2.25% in the normal trading day and 1.26 in the after hours because of Google's CapEx, of course. NVIDIA not looking too bad right now, but we know that we had a little bit of a retracement, right? Very normal retracement. The bulls are in full control right there. Higher low probably established with the low of yesterday, 165. Almost losing the 12 EMA, but not quite. NVIDIA bulls are still strong. If you get a lower high and lower low, daily downtrend, and a loss of the 12 EMA, well, you might just end up with a situation like Netflix, right? Where the bulls on the weekly just take a little bit of a very well-deserved breather and possibly come down and reach to their own 12 EMA, which at that point will probably be around the mid 150s. If we do come down to the mid 150s, I'll be a big fan of selling some put options down here, 150 to 140, where the valuation is a bit more manageable. And I love these breakout, retest, and run trades. So that's the thing that I will be looking to position in, whether it comes now or maybe into Q3. I'll be waiting patiently for it. Right now, the valuation of NVIDIA in around 170 is top end of the range. Still not bad in terms of peg, but he's starting to get a little bit, top end of the range, right? It's not a deal anymore, right? It's still solid, but it's not a deal anymore. Moving on to Tesla right now. Well, we already covered Tesla in terms of their earnings, right? We know that their earnings went down in the after hours by about 4 or 5% right now. But, that being said, where are we standing right now in the after hours? 317. So there's a line, 317. We haven't lost anything, right? Daily downtrend from the bears. Now we have a nice new daily uptrend. We will see possibly if the bulls can recover this or if they just dive into support. The daily is very messy. Why? Because we're trapped in a consolidation range here, trapped between overhead resistance 340 to 360 and down below support 300 down to 261. In the event we plunge to the lower end of support, could be a decent little entry proposition for some swing trades if you're looking to trade level to level. No swing trades for me on Tesla right now. I'd rather see them come down into the lower 300s to possibly adequately position, because then I could put a stop loss below this guy and then target an upside expansion, which improves my risk to reward. So that being said, moving on to Palantir right now. Palantir up 3.73%, not looking too bad. They literally came exactly down to where we were possibly targeting a back test, right? Riding the 12 EMA so far. I mean, they've cut it a few times, right? But the bulls have always been able to V-shape and engulf. Same thing here. Cut the 12 EMA, no downtrend, just cut and then V-shape recovery into a new higher low, possibly looking for expansion. If you do not get any new highs and devolve into a downtrend and lose this 12 EMA in a significant fashion, well, then you're just be looking for a weekly higher low. Yeah, anything above 128.71, weekly higher low for possible further trend continuation. The next area, psychological target for Palantir, psychological round numbers, 160, 170, bulls still in full control, but you got to be careful with these, right? Companies that have ran so much since last quarter in April, right? If they have anything under picture perfect earnings, Wall Street might just send them the other way, as we've seen so many times so far. They have earnings the first week of August. On to SOFI right now. SOFI 2.76% to the upside, reclaiming a little bit of the losses that we had recently. 12 EMA being maintained. This is why I say this is the momentum indicator, guys. The 12 EMA. If you lose the 12 EMA and lose the uptrend, then you're in for a bit longer consolidation. So it's just giving you guys the expectations, right? That being said, resistance still stays put 2260 up to about 2456, which is the top end of the range from 2021. SOFI is not looking too bad. The bulls are still in control, right? Right now, what we've done is we've established a new higher low. So at this point, right, they need to continue the daily uptrend. If they don't, break new highs and break these lows, daily downtrend into a bit more weekly consolidation. And thereafter, well, I mean, they have earnings next week, guys, on Tuesday. So not that much action, right? But let's say if earnings sends them higher, maybe you have a chance of cracking the resistance range. Very simple. If earnings sends them lower, well, I'll be looking to participate, guys, possibly in the lower $18 to $17 range, which is the closest backtest area that we have, and also the 12 EMA too. So keep in mind those few levels for SOFI into earnings next week. Moving on to Uber right now. Uber down about 2.02%. Not the worst day for Uber, but still struggling right here, guys. If you crack these lows, 89.36, that is daily downtrend. And then it's just more weekly consolidation, right? The weekly bulls are in full control of this chart, looking very good. Anything at this point above 82, let's call it, looking for a weekly higher low for possible further trend continuation. So we'll keep an eye on this one. If it comes down a little bit more fast and hard into the mid 80s, I'll be looking to sell some put options down there in the lower 80s, as I do believe the valuation down there is more manageable. But, you know, everything, looking at this chart, guys, no red flags, just very normal consolidation for some companies that have ran very hard in the last, 3-4 weeks before their consolidation phases. There's a lot of companies that are looking like this, but a lot of them are still buys on these dip opportunities, and I do believe Uber is still one of those. And last but not least, TSM up 2.44%. We know that they never lost the 12 EMA. Right? This yellow line right there. They also never lost the daily uptrend, looking very solid. Higher lows being set with the lows of yesterday. In the event, well, if we just continue to the upside, guys, the upside target is, of course, 250 psychological resistance, yeah? But if you get the lower high and lower low, flush the low of yesterday, guys, and lose this 12 EMA, you know what's happening, right? That is when you start weekly consolidation and when you can kind of extend your downside targets a little bit more, right? If you don't lose this, guys, well, you cannot be expecting those large consolidations. As soon as the bears tell you it's time, then we can plan our shopping carts down here at 220 for a back test, or worst case scenario, 211 down to 210. Give me a sharp pullback into 220. I might be looking to sell some put options down here, 211 to 210. So that's why it doesn't need to get down there for me to participate, right? I can sell some options down there, even if we only make it roughly halfway to there. Overall, though, and around 240, we covered their earnings last week. Very strong, and the valuation is still quite manageable. So I'm not selling any shares, but also it's not even a bad proposition. You can make an argument that even here, guys, right, the valuation is not commanding. We can add some shares, maybe not a full-size position, but if we've acquired some shares, such as me over the past few years, with every DCA that I put in my portfolio, some companies I'm not buying anymore, like Microsoft, but some companies in my portfolio I still am buying, like TSM. That's how I kind of navigate that landscape, right? So that's everything I had for you guys today. Hopefully you guys enjoyed it. As I said, tomorrow, since there's less earnings to cover, I'll be doing the biggest gainers and losers. We'll spend more time on that. But for today, that's everything I had for you. If you enjoyed today's video, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing to the channel if you're new as well. Would love to have you back. We do these every Monday to Friday after the close. And last but not least, if you have any questions, sorry, I know I talk fast, but if you have any questions, I can talk slow as well and calm. Trust me, if I wanted to, I could make these videos 20, 30 minutes. You guys know that, right? Because I've done them before. But I want to provide as much value as possible. I know it's not the best for the algorithm, but I just want to put the information out there, right? So if you have any questions, please leave them down below in the comment section. And if you want to participate in our own trading and investing community to be able to talk more with me directly, you might consider joining in the link to the link in the Discord, which is down below in the video description. In the Discord, guys, you get access to a few things. Number one, you get access to all of my trades in real time, whether those are the wheel trades, the directional trades, call debit spreads, leap call options, swing trades with shares, a whole different suite of trading strategies that I employ. You get access to all of them. Those are all the trades of the past few months, right? The green little check marks are win, the red circles are losses. So you get access to all those. You get access to our private morning live streams where I trade live and answer all your questions every morning, Monday to Friday for 2-3 hours at the open. You can ask me all your questions on your stocks, your options, and your long-term portfolios in our live streams. You can also do that in all our chat rooms all throughout the day, and I'm very fast to answer. You get access to our private video section, which is the educational section. technical analysis, fundamental analysis, how to grow in a portfolio, a small, medium, large account portfolio, which strategies should be employed depending on the size of the portfolio, different option strategies, tutorial videos, best practices by me, a whole educational series of videos that I do not post on YouTube. And lastly, but not least, you get access to all my charts whenever you see support resistance areas like this or fundamental analysis on my charts. You can copy paste all my chart layouts. It comes with everything, and you can copy paste all of my watch lists that I use for trading every day. It's just an added bonus for our members too. So if any of that interests you, the link is down below. Hopefully I see you in there soon. And if not, I guess I'll see you right back here on the channel. Take care. See you guys tomorrow after the close. Thanks for watching as usual. Peace.